Hello, I'm Kevin Flynn, and welcome to another edition of Avalon's Market Minute. It's April 14th, 2013. Markets were up again last week, naturally. Why do I say naturally? Well, if you're thinking it's because the economy or corporate earnings are going well, you haven't been paying attention. They're not. It's because it's April. April is historically the best month of the year for the stock market, and in an era when prices are being set more than ever by algorithmic trading, the trends tend to be self-reinforcing. The programs know that April is usually up, so they are predisposed to buy. Trading desks know that the trading programs know, and so they are predisposed to follow them, or for the bold, even anticipate them. The trend followers strengthen the trend. If no disaster strikes, this will be the 8th year in a row that April is up. Take the jobs report a week ago. While not a true disaster, it was one in terms of expectations. Nevertheless, within minutes of the market's sharp opening drop, prices rallied back for the rest of the day. Friday's retail sales report for March of negative growth was also a big disappointment. But within an hour or so, equities started to rally back for the rest of the day. Who's buying these dips? Well, lots of traders. The programs are buying the dips because the news, although certainly not good, doesn't fall into the category of being disastrous enough to disrupt the market. Not in mid-April. Traders and day traders follow them too, convinced of something. What kind of news could derail the markets? Well, a change of month for one thing. If the calendar had said May or June, last week's news would have weighed a lot heavier on the market, believe it or not. But it isn't yet. So for the next couple of weeks, we are still in default buy mode. Now, earnings could matter as we get into earnings season, but only if they are far worse than expected. If they're on the weak side, and corporate management isn't confident about the outlook, that will undermine the markets later in the spring, regardless of some sideshow about beating estimates. But so long as they're not an outright debacle, which I don't expect, the market can get by with very little earnings growth, even negative growth, for another week or two. News that's serious enough to pull the plug on prices would have to be some sort of geopolitical surprise or disaster or some kind of dire central bank warning. Even North Korean missiles wouldn't matter for more than a day or two unless they were carrying nuclear weapons. It'd have to be war in the Mideast or some other strategic place. A plague might matter, but even if Asian bird flu does get some more traction on China, it'll take a couple of more weeks to get going. And of course, a country leaving the Eurozone would always change the board. If the Fed or European Central Bank came out and said they're going to start tightening soon, you could put the calendar away. But that isn't likely to happen this month, or anytime soon. You can forget about the International Monetary Fund lowering its estimate for U.S. growth this year, or the European recession, or the latest batch of disappointing economic news in the U.S., and the latest batch of disappointing economic data from China, because for the next couple of weeks, it doesn't matter. But as earnings season starts to wind down in a couple of weeks, things could change. But we'll talk about that in a future edition. In the meantime, I wouldn't change your 401k plan to add more equity this quarter. I'm Kevin Flynn, and thank you for listening to Avalon's Market Minute.